Hello everybody, welcome back to another valuation investing video, and today in this video I'm going to be getting into my stock portfolio at 18 years old. And about 2 months ago I did make a video on my portfolio. That's the first time I ever revealed my stock portfolio, but I wanted to make another update on my portfolio because I believe I've had some huge activity in this portfolio. I've had some huge sells and buys in this portfolio, so I'm going to be getting into what I have added and what I have sold in this portfolio. So with that being said, let's get into my stock portfolio and let's see what activity I have been up to. Looking at my stock portfolio here, you're going to notice I only have 3 stocks, and I know everybody in the comments are going to say your portfolio is too diluted. However, I do believe that diversification can actually be bad for your portfolio. As long as you're investing in very high quality companies, I think it's worth it, especially with my age, to be in a more concentrated positions. So that's why I'm only invested in 3 stocks. I would be invested in a lot more if I believe that there's good buying opportunities right now. However, there's not really any huge buying opportunities I can see in the market as of today that I would really be jumping into right now, besides one, but we're going to be getting into what that company is, and I've been loading up on that stock, and you probably know what that is if you have been watching the videos. But first, let's get into my smallest position, and this position is going to be ASML. ASML is my smallest position here. Taking a look at ASML, my average price is $719.95. I'm up about 38%, and I started this position back during the tariff Trump news. So I started this position in about April or May. So with that being said, if you remember my past position, my average price has actually gone up because I've added a few more shares after the stock price has gone up a good amount. So taking a look at year to date on ASML at market-io here, I started to buy this company. It was during this April 2025, late April, around $630 to $650. I started to add some more shares here, and then I recently have bought some shares back when it got under $900, and I'm actually considering potentially buying some more today. But I'm going to be getting into why I'm personally not allocating more money into ASML as of right now, because I still think that there's a better opportunity out on the market. So with that being said, with ASML, my average price is $719.95, return of 38%. And taking a look at ASML stock on my valuationinvesting.money website, if you want to go check it out, just click the link in the description and you can actually get a 50% off for Black Friday. Basically all of November, 50% off your first month. It's only going to cost you $4 per month, and you can get a 7-day free trial. So with that being said, take a look at ASML. If you don't know what ASML does, is they make lithography solutions for other semiconductor companies. Their main customers are Taiwan Semiconductor, Samsung, and Intel. If you don't know what an ultraviolet lithography system is, it's basically very advanced semiconductor equipment machines for chips. And what they do is basically laser in the patterns onto these chips to ensure a much stronger chip and efficient chip. So with the huge demand for chips as AI continues to expand, this company has seen a lot of growth in their machines, and a lot more companies are trying to use ASML because of this is the only company in the world that makes EUV lithography machines. So that's why a lot of companies are trying to utilize ASML to ensure that their chips are better than each other. So this is why I believe ASML is a great company to own right now. Taking a look at the market cap, $383 billion market cap. It's a pretty big company, but it's actually the smallest company I own. So that's pretty interesting. P/E ratio of 35. So the P/E ratio is a bit high, I will like to add. The P/E ratio is definitely over the market average, so you're paying a premium to own ASML. But I'm going to be getting into why I think it's worth it to have a premium price for this company. Taking a look at the balance sheet, they have a net cash balance of $2.8 billion, so they have more cash than debt, which I really like. Taking a look at the 7-step stock analysis for ASML, we get 5 out of the 7 key metrics. The forward P/E ratio, however, is a bit high, but everything else looks good. The revenue growth, 15.5%. EPS growth, 11%. So they're growing very fast. Return on invested capital looks very good, which means they're good at reinvesting back into the business. The shares outstanding are decreasing at 1%. The debt to free cash flow, very low. They can pay off all their debt right now if they wanted to. I really like that, and I like companies with low debt. Also, with the only problem here, future revenue growth is expected to be 0.7%. However, I don't think that's accurate, and we get these statistics from Yahoo Finance for the future revenue growth, and I think this is wrong. The main reason I think this is probably 0.7% is potentially because the company recently said just a few earnings reports ago that they might expect no growth for 2026. But in their most recent earnings report, which happened a few weeks ago, they reinstated that they still expect very good growth. So don't worry about that. Now for the intrinsic value calculator here, I'm going to input assumptions here. With these inputted assumptions, I put 10% revenue growth, base case 14%, bull case 18%. The reason I did this is because ASML has stated that by 2030, they're expecting anywhere from 13 to 20% revenue growth. So I think base case, this is very conservative. This is less than what the company expects. And bull case is within the range of what the company expects. So I think these are fair. Future profit margin, right now, their profit margin's at about 29 to 30%. I think it's going to stay there because of the moat of the company. I put 23, 28, and 33 PE ratios, which is the price times the earnings multiple. Right now, they're at 35. I think it's going to go down, but I think they still deserve a premium compared to the stock market. I think they're going to be buying back at about 1%. With that being said here, I get a 10.2% annual return from today's price, and that's why me personally, I'm not buying any more of ASML at today's price. I would want to see this company get under 850, 900 for me to potentially want to add more to this position. So me personally right now, I'm not buying into ASML. So that's just what I believe. My second largest position in terms of complete value, we have Meta. Meta was not in my stock portfolio just 2 months ago, but this has quickly became one of my larger positions, and I've really been piling in a lot of money as the stock continues to fall. So if we go over here to market-io, if we look up Meta here, we can go ahead and take a look at how this company has been doing. Year to date, the stock is actually down, which the only Mag 7 stock to be down year to date. Over the past 3 months, the stock is down 21%. So this stock continues to fall. I started to add this company right at $700 back in October 10th, around this time frame, and now I've really been starting to add more as it gets under $600, and today I actually just bought another share. So at $585, I just bought another share of Meta stock. So looking at Meta here, my average price as of today is $644 per share, and I'm down 9% as the stock's at $585. So I am down on the position, but I'm honestly happy, and I want to continue to be buying Meta as it goes down. However, it is a pretty large position, so I don't want to be adding too much more, but I really do like Meta, and I believe there's good things coming with Meta in the future. So taking a look at Meta stock here, if you don't know what Meta does, most people probably do know. They own Facebook, they own Instagram, Messenger, WhatsApp, they own all these platforms. And the main way they make money is through advertisers paying to be on their platform. And that is almost 99% of their revenue comes from advertising. So this is a more riskier play than, say, another company like Google or another advertising company, because this company is very concentrated into that revenue segment of just advertisers. So if a recession were to happen, this could potentially really hurt Meta. So you got to be careful with that, but I still believe that this company is going to grow and diversify the business in the future. As we can see, the market cap of 1.48 trillion. So this is another huge company in the Mag 7, one of the biggest companies in the world. With the PE ratios, these look pretty good. And at 25, that's about market average. And with Meta, I think that's very good since the company is growing much faster than the market average. The free cash flow yield, however, is pretty low, which is slightly worrying. I want to see that pretty high at about 3 to 5%. That would be a very good place for the free cash flow yield. But the balance sheet here, the net cash is negative $6 billion, which I do not like about Meta. I would like to see Meta at a better debt to cash situation. This is the only thing I don't love about Meta. And another thing I don't like is the CapEx spending. And that is the main reason the stock has been tanking. They've been spending so much money on AI that they have been raising their CapEx guidance every single quarter this year. Their CapEx spending is supposed to be $70+ billion, so they're expected to be spending a lot on AI, and that is giving concerns for investors because just the sheer amount of spending on AI, if it doesn't work, that's going to really hurt the company in the future. But taking a look at the 7-step stock analysis, 7 out of the 7 key metrics are checks. So everything looks very good for Meta there. Now for the intrinsic value calculator, I'm going to input some assumptions. Bear case, I'm going to put 8% revenue growth. Base case, I'm actually going to do 13. Bullish case, let's put in 18%. I think that they can grow at a 13% base case. Just last quarter, they grew 26% year over year. So I think these are very conservative numbers, but I want to take into account in case there's some recession or just economic hardship, advertisers are going to be not willing to pay as much for advertising, and that's automatically going to decrease their revenue by a good amount. So I'm taking into account potential for economic uncertainty in the future, which will in turn create more conservative numbers for Meta just because of the sheer dilution, the sheer market share that Meta has in advertising at 99%. It's a bit harder to predict the future for a company like Meta compared to say Microsoft, because Microsoft has recurring revenue but Meta doesn't. So it's a bit more cyclical company, and that's why Meta fell so much back in 2022. Since there was some economic hardship, the revenue growth went near flat. That's what we need to worry about for the future, but I think long term, Meta will continue to grow very good. Now for the future profit margin, I'm going to put bear case. Let's do 32. Right now it's at 30, but we have to keep in mind with their recent earnings report, they did report an anomaly in that with their earnings per share because they reported a huge tax expense with the big beautiful bill that is going to actually decrease their future taxes, but this is a one-time expense, so that automatically lowered their profit margin by a lot. Their profit margin in reality is from 35 to 40%, so we have to keep that in mind. Base case, I'm going to do 37. Bullish case, 42% profit margin. Now for the future PE ratio, I'm going to put a 20 PE ratio. Then I'm going to put a 25 and then 30 PE ratio for Meta. Now for the shares outstanding, I think these are fair shares outstanding numbers. Taking a look at our intrinsic value results here, with the base case, again, 18% annual return here. If you believe the bull case, I think you can make 32% here, and I honestly think that could be possible if their capex actually does return a bunch back to the business. If this spending really does help the business grow even faster, this could be a huge investment in Meta, and that's why I continue to buy, and that's why I'm allocating more money into Meta, and this is the only real company I've been buying in over the past few days and weeks. But I have been adding to another position, which is going to be my final and largest position here. But before getting into my largest position, I'm going to be talking about two of the positions that I used to own that I have sold out of. The first one is going to be Fortinet, and Fortinet I did make a decent return on. It wasn't a great return, but I decided to sell the company just due to the sheer fact that I would plug in some numbers for Fortinet and not get great returns with the company. I decided that the margin of safety I had with Fortinet wasn't large enough, and also in the business that they're in, cybersecurity, there's a lot of competition, and I wasn't willing to pay that much for that company, and they have decelerating growth, so that's why I sold out of Fortinet. The other company that I sold out of, which may be a bit of a red flag for some of you, I believe it's worth it just because of my age and my risk tolerance in the future. I sold out of Visa. Visa, don't get me wrong, is a great company. I think you can make decent returns with the company, but I personally don't believe that you're going to outperform the stock market with Visa. I think Visa is a very good compounding company, but I just don't think that you can outperform the market with Visa. I think it's just going to be a normal market performer, and that's why I sold it, because my main goal is to outperform the stock market with this portfolio, and that's the main reason I sold out of Visa. So those are the two stocks that I sold, but here is my biggest position. It's probably not a big surprise to most of you. It's going to be Google. Google right now, my average price is at $187.93. So from last video, you're going to notice that this average price has gone up a bunch. I've been buying after the judge ruled that Google Chrome is going to be is not going to have to be sold off. And after all the optimism around AI, I've been adding to this company. But right now, I think this company is at a price that you probably shouldn't be adding to. So with that being said, if we go over to the market-io website here and we put in Google stock, I want to take a look at the stock price of Google here. So taking a look here, Google year to date is the best Mag 7 performer, up 53%. So if you didn't know, I actually owned Google for a while now. I started buying back in 2022, 2023. Not a lot of shares, not when I had a lot of money to invest, but I really started loading up on this company once it got under 160. Once it got under 160 back during March and April, I really started to buy this company and have continued to buy on the way up. And now I'm basically out of buying this company unless we get a huge crash in the stock around under $250, then maybe I'll add some more. But me personally, I think the best company to buy right now is Meta, but Google is still a great company. I just think the valuation has gotten a little bit too high. So taking a look here at Google on my website here, if you don't know what Alphabet or Google does, their main source of revenue is their Google search engine. That's about 70 to 80% of their revenue, I'm pretty sure, in that area. So it's still a huge chunk. But I do like Google more than Meta just because of the diversification of Google. As we know, they own Chrome, they own Android, they own every single Google application or app like Google Docs, Google Slides. They own all that. They own Google Play. They also have YouTube, which you're watching on right now. And I think this is actually one of the best, the most underlooked service of Google or Alphabet, if you want to call it that. I like to say Google just because it's easier for y'all to understand, but Alphabet, because I believe that YouTube is actually the best video service. If you didn't know, recently some data has come out that YouTube is actually the largest YouTube is the largest video service in the entire world, beating every streaming service, beating everything else. So they have more views than any single streaming service. So that's why I believe YouTube is such a key area for Alphabet to continue to help their ads, and this is just continuing to give them more money. And also there's other things like Google Cloud, which is their AI infrastructure. I think that's going to help them really grow in the future. That's a very good source of growth for Alphabet. Finally, you have Waymo, which is their other bets, which if you don't know what Waymo is, it's basically self-driving taxis. It's like robo-taxi for Tesla, but Waymo is actually already been implemented in plenty of places, and they're starting to see a road to profitability. So I think this company is really good for the future. I think the future looks amazing for Alphabet, and the reason the stock was doing so bad just less than a year ago is due to the uncertainty of whether AI is going to hurt this company. And people have started to realize that AI might actually help Alphabet in the future with their most recent earnings reports, and I believe that is the case with Alphabet. Look at the market cap, $3.53 trillion market cap, one of the largest companies in the world. The P ratio at 28, so it's still pretty high. It's higher than Meta, so that could be a concern, but I do think that this company has a bigger moat than Meta, and it's more resilient to economic downturns. And also the other thing I really like is the balance sheet, the net cash, $54 billion of net cash. They have so much cash, it's insane. They have almost $100 billion in straight cash, and this is very good for Alphabet. I really love Alphabet. Taking a look at the SemStep stock analysis, we get 6 out of the 7 key metrics. The only thing that's bad is the valuation. It's not too bad at 32, but everything else looks amazing. Revenue growth at 11%, EPS growth 16%. They're buying back a lot of shares, which you all know I love buybacks because that's going to return even more back to the investor. Everything looks very good for Google. So if we input some assumptions here, bear case, I'm actually going to put 9%. I know they've been growing at about 11% over the past 5 years. However, over the past year over year, they actually grew 16% revenue growth. I think Google could potentially start to re-accelerate their revenue growth. I know it might sound crazy, but I think Google can start to grow 15 to 20% over the next few years. But I'm still going to be conservative base case, but bull case, I'm going to put 17% growth. I think that with AI, Gemini 3 coming out, Gemini 3 just launched, everything's looking good for Google. AI, I think, will really help this company out. Now for the future profit margin, I'm gonna put a profit margin of 29. Right now it's at 30. I think they're gonna accelerate their profit margins up to around 35, 32% for Google. Now for the future P ratio, I'm gonna put a P ratio of 22 bear case. Base case, let's do 27, bullish case 32. Now for the shares outstanding, I think they're gonna buy back at about 2% each year. So taking a look here at Google, I get base case 13.7% annual return. So me personally, I wouldn't be too opposed to adding. I've added a few around $270 to $280, but I think my position's already big enough. I still think I don't think you should be trimming any of your position if you're in Google. That's just what I believe. I think that this company can have a huge future ahead, and that's what I believe. So would I be necessarily starting a position today? Probably not, but I don't have to worry about that since I'm already in it. So that's just what I believe. And I believe that Google is a very good company to own. I think you can't go wrong with buying Google, but I do believe right now Meta is a better value for your price. And if you want to get into a starter position, that's why I've been buying Meta. So that's the main reason. So with that being said, I really do like Google, but from today's price, it's still just a little bit overvalued. Even though I think you can get 13% return, I'm personally not buying right now. I'm just going to be holding, being a happy investor in Google, and I'm really glad that this is my largest position in my portfolio. So taking a look at my portfolio overview here, we have 45.3% of my portfolio in Google. We have 28.4% in Meta and 26.3% in ASML. So Google is almost the majority holding in my portfolio, and actually Warren Buffett just bought Google a few days ago. So I'm not saying that means you should be buying Google, but that gives you even more confidence in Google that it's going to be a great company in the future. And I really like this. I really like my portfolio right now. I would like to add more to some other stock or some other company, but right now I just think valuations are a bit high, and I'm just personally waiting and sitting on some cash. So thank you guys for watching this video on my updated portfolio. Please subscribe, hit the like button, comment down below, and if you want to go check out my valuation investing website, click right here. Like I said, code Black Friday, you get 50% off. So it's only going to be $4 per month for the first month. So thank you guys, and see you.